Certainly, if you've got the budget for Sydney, you've got an opportunity to get in while the market is still balanced. It's not favouring the vendor. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to do the 2025 market outlook. Yes. Does that sound riveting? We're now in 2025. We are 2025th people now. We are living in the age of an election year. We're living in the age of Trump once again. And of course, when it comes to our property markets, there is no such thing as an Australian property market. Some areas are going to do better than others, and some marketplaces are going to lag behind. But of course, could that create an opportunity? Let's discuss what next for 2025 and the real estate economy. But before we get into the show, it's a big welcome back, regulars. I hope you're enjoying your festive holiday break. And of course, if you've got time and you're sitting on a beach like a lazy seal, you can actually go back in time and listen to multiple episodes of the Urban Property Investor. Why not spend your holiday season listening to the soothing sounds of my voice and the wisdom of real estate? If that sounds like you, go back in time. But if you like keeping up to date with the episodes, today we're going to dig into 2025. Where does it break down? Where does it excel? Who wins? Who loses? Let's talk about the real estate marketplace. And I think one of the best ways to start a conversation around the real estate marketplace and the type of predictions which come out is quite often who is behind the predictions. We can get predictions from banks, we can get predictions from SQM Research, we can get predictions from Oxford Economics. Today, I will report some figures from both SQM Research and Oxford Economics. Oxford Economics, if you like, is a non-banking entity economist overview of where they see the market going. As we know, banks have been pretty lackluster with their predictions over the years. When they predict the market's going to go down heavily, the market goes up. So I often think banking predictions perhaps need to be taken with a grain of salt. We're also going to explore today data from valuers. And I think this is some of the most exciting metrics really coming from the front line. If you can imagine, the real estate market is full of properties, full of dwellings. And when those dwellings are sold, quite often a human being a valuer, goes to those properties and really sees what's happening live in the marketplace. They are as close as you can get to a frontline soldier when it comes to real estate transactions and the behavior and demand levels in the marketplace. So we're going to report today on what valuers are seeing, what Oxford Economics is seeing, and what SQM Research is seeing. I like SQM Research because they create scenarios for their growth rates, which I think is prudent. For example, if the cash rate comes down, what does that do to the real estate marketplace? If population growth slows, what does that do to the real estate marketplace? And Oxford Economics are basically a huge worldwide organization, so it is quite good to get their viewpoint on what next for Australian property. But if we go to the valuers first, if we were to look at the valuers surveyed in a recent CBRE research report, the most valuers are purporting that the market is now balanced, meaning neither the buyer is in charge nor the seller. We are now at a point where really, marketplaces are very much balanced to the point where at a macro level, the deal that needs to be done could go either way. You could be paying more for properties, you could be paying less for properties. Interesting enough, though, if you looked at the valuers' responses to where they see very strong demand, they are seeing it in Adelaide, Perth, and Brisbane. This is where the demand is still very, very buoyant. Whereas the ACT, Canberra, and Sydney, demand is less abundant. So aggregate demand is shopping in certainly that sort of Perth and Brisbane in particular marketplace still to this date. Obviously, that can still create an opportunity to buy in Sydney and Melbourne and Canberra. It's just a different approach. If there's more demand in the marketplace, it means obviously you're competing for product. If there's less demand, you're not competing for product. So usually that means you can mold a better offer and a better price. But if we look at the buyer subgroups of who's shopping in the market, according to valuers, if you were to break down the classification of buyers converting on real estate, you've got upgraders, first home buyers, local investors, downsizers, interstate investors, interstate migrants, developers, and recent overseas investors or migrants. If you look at where the bulk of activity actually is, according to valuers, where aggregate demand is, it's firstly in those upgrader markets, closely followed by those first home buyer marketplaces. And interesting enough, people are investing locally at the moment rather than necessarily interstate. There's a lot of local investors happening in their own backyard, which is quite interesting. So I said it at the start of the year that there would be a flight to affordability. And we are seeing that with the amount of first home buyer numbers coming out of the valuers data. First home buyers are really scooping up that investment stock, putting pressure on the investment end of the marketplace. But properties that have experienced the highest level of demand change, in other words, they're quite popular at the moment, are effectively established houses, new houses, and recently renovated properties. They are getting a lot of demand. And so if we were to think about recently renovated properties, obviously a lot of people don't want the complexities of renovation because of the maths behind it. New builds, though, still increasingly popular and getting a high level of activity, as are the established houses. And of course, interesting enough, if you look at some of the valuers' comments, affordable established homes, villas and apartments are experiencing strong demand in Perth, as well as new houses. If you look at some of the other popular properties which are coming through the system, which are increasing their demand base, it's also townhomes and villas, which of course makes a lot of sense because of that flight to affordability. So when valuers were asked where they see the market headed in different states, they've provided some opinions, and around 35% of them reported that they believe the market will stay the same price. A further 35%, call it, believed it would increase by around 5 to 10% in certain marketplaces. So if we were to look at the marketplaces, valuers are looking at where they think the market demand is so strong that prices will rise. It is Perth, Adelaide, Brisbane, certain pockets of Sydney, and certain pockets of Melbourne, which are expected to do pretty well by anywhere from sort of 5 to 10%, which is great. So there's going to be capital growth predicted by valuers, which is interesting because valuers obviously provide the key to unlocking equity. So if they're saying a marketplace is quite strong, they will obviously support it and unlock that equity. They have Perth as the strongest market, followed by Brisbane, and the least impressive market they have is Melbourne. And so if we're buying in Melbourne, we've got to look for value, which is not a bad ploy when you're openly in a bottom of the market concept, which is exciting. So valuers are all over it. And certainly when it comes to the residential property outlook by Oxford Economics, there's some interesting things to talk about. So Oxford Economics, as I alluded to, one of the biggest economic houses globally in the world. They look at all sorts of things from measurements of iron ore to, overseas tourism, to what's happening in the United Kingdom, to, a political fallout in Romania. So they're across a lot of channels and they're not singular market focused. So I use and buy a lot of their data, and I do that because I really enjoy their, non-banking influence as well as reporting. So they're not basically lending people money. So they're not going to report on numbers to sell home loans differently. Now, interesting enough, we just hit a median priced home sits at $800,000 today. And we've hit that number back in December, which is very, very interesting when it comes to analyzing what next for property marketplaces. And it's interesting because we've got to approach buying in different places differently. By way of example, if you were to buy in Melbourne, you're sort of bottom of the market buying, so you've got opportunity to get a really good price, influence the vendor, and get an outcome. If you're buying in sort of Perth or Brisbane, though, you're really still, for the most part, competing with other buyers. So you've just got to take on board, if it's an A-grade property, you may be competing with other people. But what is clear, according to Oxford Economics, is stock deficiencies. There's basically not enough dwelling completions, and underlying demand outweighs completions of dwelling stock. And that in itself leads to what next for pricing according to them. Now, it's pretty clear in their chart book that Sydney units and houses will gradually go up in both in Sydney in 2025. But things start to improve a lot for Sydney in 2026 and 2027, which is quite interesting. So certainly if you've got the budget for Sydney, you've got an opportunity to get in while the market is still balanced. It's not favouring the vendor. As for Melbourne, it's quite an interesting chart book because it does allude to the fact that Melbourne through 2025 will have a bottom of the market situation unfold. Sales could drop in value, prices could come down a little bit, and of course, that's good news for buyers because obviously it allows you to pick up a bargain if you're a value investor. If you're shopping on momentum and you want capital growth in 3 months, Melbourne's probably not the marketplace for you. But if you are shopping on, I would like to get a good location at a more affordable price and drive a bargain, then Melbourne is probably your best bet. Oxford Economics has the market restoring to basically a even state early in 2026 and then starting to power up from a capital growth point of view from that point to the point where by the end of 2029, the median house price for a house in Melbourne, which currently sits at about $980,000, blows up to about 1.4 million. So interesting forecast indeed. So if you're stuck for a marketplace and you've missed out on capital growth everywhere else, you're probably best to go to Melbourne because you're not basically paying for the last 5 years worth of capital growth for that marketplace. And we look at SQM research stock levels for Melbourne. It's been pretty well the same story since about 2019. Similar levels of stock on the market for the last 5 years. And obviously that in itself just tells us we've got a bit of a balanced marketplace. But if we look at the micro data of future supply and future completions, it's very, very low. So we know the market stock-wise is going to be devoid in Melbourne. As for Brisbane, if I look at the chart book for Brisbane, according to Oxford Economics, it's all sunshine. There is basically capital growth afoot. The median house value will rise in value, and the median apartment will rise in value. And it will continue to rise in value pretty well all the way up to 2029, according to Oxford Economics. And really, a lot of that is just coming down to why this prediction is interesting, is coming down to just a real challenge to get product to the marketplace. Obviously, economics is a river, not a lake. I say that all the time now, but it's true. Anything can change. Political interference could come in and do something strange, but for the most part, Oxford Economics is predicting some pretty incredible capital growth rates. Now, again, if we look at SQM research, we can see that stock levels in Brisbane are very, very low compared to the average across, say, 2011 to 2021. It's much lower, about virtually 30% less stock on market than during the last decade, which is incredible. It's obviously a reference to the demand levels in Brisbane. Similar in the Gold Coast as well. And then if we flow over to the chart book of Adelaide's growth potential, it's also rising in value. There doesn't seem to be a slowdown or pullback on Adelaide prices. But again, maybe you have to weigh up, well, if I get the capital growth in Adelaide, on my budget though, I'm now pushed out further and further afield to a more speculative suburb. What if I was to go the opposite direction and buy a better suburb in Melbourne, but just realize it's going to be about 12 to 18 months before that growth rolls out? It's kind of the two choices you've got to weigh up. And Perth, well, Perth again is the rock star according to Oxford Economics. It's nothing but a high growth market at this point. Canberra goes sideways through 2025 and then starts to increase handsomely in value in 2026. So these are the reports. This is what's going on. And of course, if we were to look at combined capital city rental growth, it is also drifting up. If we were to look at Sydney, you can see by the end of 2025, about the average rent of a dwelling goes from sort of 750 to about 775. So interesting, rents are still on the rise, but not as sharply as the previous 3 years. If we look at Melbourne's rental forecast, it's quite interesting because your median rent of circa 550 ends up becoming circa 600. So a little bit of movement in the rental market there, but really at the end of 2025, not at the start of 2025. So think about that with your lease renewals. Brisbane, pretty similar to Melbourne, actually. A little bit of growth possible in rents towards the latter half of 2025. And probably your average rent going from circa 600 to about 620. So interesting what is unfolding. Pretty similar in Adelaide to Brisbane, actually. So keep an eye out for that. And also Perth is going from more or less $600 median rent at the moment, and will probably climb to circa 650 by the end of 2025. So there is some rent increases there. I've personally thought maybe the rental market's tapped out. But hey, if we follow what Oxford Economics has got to say, we can maybe find ourselves a bit of rental growth in the marketplace. And finally, Canberra, it kind of goes sideways from a rental growth perspective in 2025 before starting to slightly nudge up in value in 2026. So no real major rental growth happening in that marketplace. And finally, if we get over to Oxford, if we leave Oxford Economics and bump over to SQM Research, we can look at some of their capital growth predictions. Now, they've got a couple of scenarios when it comes to capital growth. Scenario one is 25 to 50 point rate cut in mid-2025. Most economists are reporting that rates will drop now in the middle of 2025 rather than the start. And really, when you think about it, the Reserve Bank of Australia really just has one mandate, which is to control, two mandates, to control inflation and to control employment. That's really what their mandate is. They don't have a mandate to make it easier for you to pay a home loan, nor me. That's not their actual why they're set up. They're set up to make sure inflation doesn't basically eat our wealth, and also to maintain a level of full employment. The challenge for the argument of a rate drop is employment is too good. There's too much employment. And of course, the services nature of Australia's, architecture means that, there's jobs out there. But of course, as we know, a lot of jobs aren't keeping up with what it costs to buy a house. The median value of a house in Australia is $800,000. So we've got now a lot of working poor in this country, and then we've got an eradication of the middle class. But what is happening is it's just a little bit more job cuts need to happen for the Reserve Bank of Australia to justify lowering rates. But the forecast is pretty good that eventually it will happen, and a lot of the banks have a forecast of rate cuts, as does Oxford Economics. They have forecasts of rate cuts for the second half of 2025. So we will end 2025 with a lower cost for our mortgages than this year. But Oxford Economics, they basically put out that there's certain scenarios. Scenario 1, a rate cut, a mild rate cut of 25 to 50 basis points, but a huge population growth rate of over 500,000 people and no new inflation, so no inflationary outbreak. Now, in that scenario, they've got Perth doing anywhere from 14 to 19%, Brisbane 9 to 14%, Melbourne basically going sideways, Sydney going sideways, Adelaide doing 8 to 13%, and Hobart and Canberra also going pretty well sideways. So SQM actually have, like, if you want to understand sideways, it could be anywhere from plus growth of 1% to negative 5% growth rate. So as a blend, that's what that scenario reveals. The next scenario is no rate cut whatsoever. And no rate cut in 2025, but the population grows by 500,000. It's the size of Canberra, 500,000 people. That lowers the growth rate across, obviously, the marketplaces. For example, Perth was 14%. Now it drops down to 7%. Perth was 14 to 19%. Now it drops down to 7 to 11%. Brisbane was, on the previous scenario 1, 9 to 14%. Now it drops to 5 to 9%. So the markets basically adjust for the inconvenience of not getting a rate cut. And again, Melbourne sort of -7 to -3 in that scenario. Sydney -8 to -4. Hobart -5 to -1. And Canberra -8 to -3. So if you're buying in sort of Sydney, Adelaide, Hobart, and Canberra, you've got to shop on value. You don't want to overpay. You do not want to overpay because the market itself, you have to compensate for the market direction by buying well. But again, places like Melbourne, it's not such a bad thing because you're getting a bargain and you're not paying for previous capital growth, which has occurred in other marketplaces. Now, if we go to a rate cut in March, an early year rate cut, and still this population growth rate continues to be over $500,000, man, the markets just take off pretty much anywhere from 15 to 20% in Perth, 11 to 16% in Brizzy, Darwin even 6 to 10%, Melbourne 2 to 6%, Sydney 3 to 7, Adelaide 10 to 14%, Hobart 1 to 3, and Canberra 2 to 6. So we can see if the rate cut comes early, then actually there's more time for the year to create capital growth. Really what you're doing is you're bringing forward 2026's growth potential and spreading it over 2025. And then really the final scenario, population growth falls less than 400,000, which again means we're not stimulating GDP growth because we're not bringing as many migrants. No rate cut. So that scenario, if there's no rate cut in 2025, which there will be, but if there's no rate cut, the growth rate is a lot less across the capital city average, basically from 0.4% to 0%. So that's kind of what's happening. And then if we look at the dwelling rental forecast according to SQM research, Perth around 8%, Brisbane about 3%, Darwin and Melbourne in the 5s, which is great. Adelaide, 11%, Sydney, 2%, Hobart, 1%, Canberra, 2%. So it's pretty similar to Oxford Economics' forecast for rental growth. So probably your rental growth markets, according to both chart books, is your sort of Perth, your Adelaides, and your Melbournes, which is good, but probably happen in the middle half of the year if you look at the micro data. So 2025, the year of understanding how to buy. You've just got to relay how you buy to the macro marketplace. If you're going to buy in a hot market or a rising market, you've got to approach that with also a little bit of making sure you don't buy a blunder investment. You don't pay too much just because the market's red hot, and you don't buy in an area which really in a slow market would be a bad suburb. It looks great today, there's capital growth on it, or, an old creepy asset where you can get some capital growth on it, but then you got to hold it for 15, 20 years. And you're like, why did I buy this thing for the quick hit of capital growth? So obviously buy a good asset in your marketplaces. It all comes down to asset selection. So make sure you choose a good asset first in all marketplaces, because the market dynamics are very, very interesting. Prices have risen. There's been a lot of capital growth in many marketplaces. And obviously in a marketplace where there's been a lack of capital growth, eventually you get that reversion of the mean. So you're closer to a future growth rate. But the advantage of course is when you're at the bottom, the seller is more nervous than the buyer. If you're holding real estate in a marketplace going through the bottom, you've just got to hold on. You can't really do much about it. I would basically come back in 2026 and look at obviously what you can do with your asset then. But those flatlining markets, your Sydney, your Melbournes, your Hobarts, your ACT, just going through a different cycle. And it's very normal for Australia to have different cycles. It's great because it allows you both opportunist buying and momentum buying. Two different things. Value buying at the bottom, or momentum buying by riding the bull. I'll leave it up to you as to how you want to approach the cycles around Australia. If you want to drive a bargain in an opportunist market, or you want to ride the wave, I'll leave it up to you. But remember, always buy a good property and use my Forex growth plan. Deal growth, make some money out of the deal. Location growth, it's a really key principle. Make sure you buy in a location which is going to get both the halo effect and the neighborhood effect. The neighborhood effect is simple. People want to stay in the neighborhood. The halo effect is people from outside of the suburb want to live in the suburb. If you can put those two together, you're going to have a good location. Obviously, the market momentums are different. I've explained the market, so good luck with that. You choose wisely which market suits you. And of course, the final thing of the Forex growth plan is those differentiated growth, behavioral growth. If you've got the right property, it'll have the right view line, it'll be in the right street, it'll have the right look and feel, it'll have the right land size, it'll have the right design behind it, it will have the right blend for its capital growth rate. All right, folks, that's it from me. Thanks for tuning in. We'll do this market report maybe in 2026 again. Can you believe it? Next year, 2026. But that's what's in store for 2025. Let's see if it unfolds. All right, folks, take care. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.